this video, we are going to talk about liabilities, especially current liabilities. As we know, the liabilities are the debts that the business owe to the creditors. They are obligations basically. They are there because of the past transaction. In case if you have borrowed money, you have borrowed merchandise, borrow inventory, anything that you have borrowed in the past, it will be considered a liability. What are current liabilities? The difference between a current liability and a long-term liability. Current liabilities are due within the next 1 year or within 12 months period. Usually accounts payable, salary payable, utility payable, rent payable, unearned revenue are considered current liabilities. The long-term liabilities are long-term notes payable, bonds, and leases. The notes payable can also be a current liability or a short-term liability if they are due within the next 12 months. Okay. The current liabilities most of the time needs to be paid using cash and using cash, and sometimes you may end up giving them something of a value as well. Examples of current liabilities, as I said, it's accounts payable, sales tax payable, unearned revenue, rents payable, utilities payable, things like that. What are sales tax payable? For example, if you are doing business in the state of Texas, you collect sales tax on behalf of a state of Texas from your customers. The sales tax that you collect on behalf of the state of Texas from your customer, it is not for you. You are basically keeping it to pay back later. Sometimes some businesses return the sales tax every month. Sometimes it's 45 days, and for some businesses it's no more than a quarter, so 3 months period. Unearned revenue is a revenue, it's a liability because it's the revenue that you have not earned. For example, you are running a bakery and I place an order for you to deliver the cake 2 weeks from today, and I gave you the full price of the cake, say $100. So for the next 2 days, that $100 that you have received will be considered an unearned revenue, a liability, because after accepting the money from me, you are obligated to provide me a cake in 2 weeks times. These are the examples include tickets sold in advance for an event or a down payment on merchandise. Because the revenue hasn't earned, that's why we call it a liability. To record, we do this transaction. Say you as a business receive a cash and it's an unearned revenue because you have not provided a service. Once you provided the service or the product, you debit the unearned revenue, that's gone, and then ticket revenue becomes your actual or true revenue that would go from to your income state. So unearned revenue is a liability that stays in the balance sheet, and once you earn that revenue, that liability moved from balance sheet to the income stated as a true revenue. The next thing is short-term note payable. The short-term notes payable are the payable that are due in less than 1 year. So it could be a 3 months, could be a 6 months period where you have to pay this liability, in that allotted time. Business usually borrows money frequently for a 3 months period, 6 months period, 7, 8, 9 months period. So when you have this liability that you have to pay back, it's when you borrow the money on a notes payable, it's basically notes is called a promissory note that has all the information, the name of a creditor, the name of a debtor. Creditor means the person who's lending, the person or institution lending the money, the information about a debtor, the person or the business who's borrowing the money, the amount of money borrowed, the duration of the time, whether it's 3 months, 6 months, 7 months, 8 months, or a year or 5 years. Also is the interest rate, how much interest rate they're going to charge, and and when the due date is and the issue date is, so they can calculate the total interest rate for it. Sometimes the current portion of the long-term notes payable could be due. Sometimes banks lend you the money on the basis that you pay a part of the principal or the amount that you have borrowed on a yearly basis. For example, as a business, you have borrowed $1 million for the next 10 years, and the banks require you to pay $100,000 plus the interest. So at the end of the first year, you're going to pay interest on the $1 million, and you also pay the principal $100,000. Next year, you will pay the interest on $900,000 and also pay an $100,000 as a principals to back. This sometimes, for various reasons, banks make these restrictions. Interest payable, how to calculate an interest payable? For example, in this corporation signed a 90-day note, means they are borrowing the money for $90 on November 1 for $10,000 with a 6% annual interest rate. So here, this is the principal amount. This is the issue date. This is a duration, 90 days or 3 months, and this is the interest rate. So to record the purchase of the equipment, and because they are buying the equipment by giving a note, so they don't have the cash, so they're giving so on November 1st, the company received the equipment and asset that they debited for $10,000, and they credit the notes payable for $10,000, means they have a liability to pay off this. Since they purchased this on November 1st, so on December 31st is the end of the year. So they will calculate how much interest they have accrued by the time. So 10,000 multiply the interest rate is 2/12. The reason is 2/12 because the business owes them only 2 months of interest. So from November 1st to December 31st is only 2 months. So the interest expense for this is equal to $100. So they say the interest expense for the first 2 months is $100 and credit the interest payable for $100. Interest payable means they owe the interest, but they haven't made the payment yet. And then on January 31st, the 90-day period is completed. So there is an interest expense for January as well. That would be calculated in the next year. And the interest payable from here is $100 and the so they are going to pay $10,150. So this is the journal entry to pay the payment interest payable from the last year, the amount that they borrowed, and this is the interest for the last 30 days or the third month. The next thing we're going to discuss is contingent liabilities. Contingent liabilities are liabilities resulting from the past event, but it's contingent upon some event. So is a potential liability, means the liability may or may not occur, depends on future event. Recording depends on the likelihood. Likelihood just simply means a chance or probability of the future event, and the ability to measure the obligation. So the ability to measure means the business ability of measuring the obligation. For example, you are doing a business and EPA fined you for polluting the water or the lake, just the lake that is adjacent to your business, for example, and their fine is $100,000. Fine, you receive the fine from the EPA and you discuss this with your lawyer and accountants what the business needs to do. So the lawyer suggests you that there is a 20% chance that you have to pay the fine. If there is a 20% chance, we call the likelihood as remote. If there is a reasonably possible, that means it's a 50-50 chance. And if this probable, it's greater than 50%. So if they say is remote, you don't have to do anything. If there is a 50-50% chance, you have to record this and you say debit contingent and credit contingent liability, and then you say it's $100,000, and then you're going to credit $100,000. If this is a 50-50% chance, you only going to notify in the notes to financial statement. And if there is a greater than 50% chance, you will do both of those things. You notify in the notes to financial statement, and you also going to make a contingent loss for $100,000, and current liability is $100,000. You are just letting the readers of the financial statement know that you have been fined by EPA, and then you might have to pay $100,000. These could be examples include lawsuits, environmental cleanup costs, or credit guarantees. It could be any of these things, but depending. So who's going to tell you what is the possibility? These possibilities are going to come from the lawyer, and this piece of information is completed by the accountant. So that is the reason you share this information with the lawyer and the accountant both at the same time. So the lawyer is going to give you these possibilities, which one is the most likely, and then the accountant will do the rest for you. The next thing we're going to talk about, recording the liability. I've already recorded the contingent liability. Record the liability on the balance sheet, of course. Likelihood of the agent is probable, which is greater than 50%. Reasonable estimate can be made of the amount of obligation. For example, EPA already sent you the bill that they're going to charge you for $100,000. Disclose in the notes, but do not record on the balance sheet if it is 50-50. And ignore when it's less than 50% of the chance. So the next thing we're going to talk about is mortgage payable. Mortgage payable is a liability. For example, you open a business and you're doing a business in a mall and you purchase the shop. If you purchase the shop, you put the down payment and the bank says, well, this is a $100,000 shop. You put $20,000. Now you owe them $80,000, and this $80,000 says due in the next 15 years. So they're going to charge you a few $100 every month for the next 15 years for this. So that is called a mortgage payable. From the perspective of buyer, the mortgage is considered a long-term liability. It's a 15 years greater than 1. Any portion of the debt that is payable within the next classified as a short-term liability. So all the mortgage payment, monthly payment that you are making would be considered short-term liability. What are bonds? Bonds is a way of borrowing a large number of cash. For example, 100,000 or $1 million is not a big deal. A bank can lend to one business. But when we are talking about $10 million, $50 million, $100 million, what they do, they take that $100 million and divide them in $1,000 pieces. So we have 100,000 pieces of bonds, and these pieces can be sold to various people. These are usually for a life is 5 years, 10 years, 15 years, up to 30 years. So these bonds could be long term. The face value of the amount, face value is always $1,000. Then there is a issue date. There is a maturity date that determines whether it's a so this information is going to give you there is information about the creditor, there is information about debtor, so all of those information. The maturity date is the date on which the borrower must pay the principal amount to the bondholder. If it is a 5 year, that means you would have to return that $100 million at the end of 5th year, or at the end of the 10th year, or 15 year, or 30 year, whatever might be the case. A stated interest rate is the interest rate that you will pay on a monthly basis. So for example, if the stated interest rate, for example, is 5%, and you purchase one $1,000 bond, so that means every year you're going to receive $50. A bond is a very good way of minimizing the risk for the lender, because when a lot of people buy this and the borrower loses this money or file bankruptcy, so every person who is holding a $1,000 only going to suffer $1,000 loss. In case if a business borrow the money from the bank for $100 million, that in that case, and the business loses that $100 million, the bank will have to face or cover the entire loss. Okay, so this is the information about our current liabilities. We'll meet in the next lecture regarding accounting cycle.